Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 331 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about dividends, and specifically why dividends may not be quite what they were in recent past for investors, and exactly why that is, and what type of impact dividends can have on your investments, and ultimately what impact dividends are currently having on your investments, if any at all. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, very quickly, let us just recap what a dividend is, right? What is a dividend, right? Dividends are just basically payments made to investors by the company that they are invested in, right? And these payments, they aren't, for anything in return necessarily other than your investment. They're just payments, right? It's just money that's given to investors, right? To keep them interested, to keep them engaged as investors, to not, get them to go invest in something else, right? These payments are made, and investors in general like dividends, right? Investors like having capital returned to them. Now, who pays dividends? Well, not a ton of companies, right? Relative to the whole universe of companies, right? But overall, there are a lot of companies that do pay some dividend, right? They pay some amount in dividend to investors. And again, investors typically like this. Now, the thing about paying a dividend that's a bit strange, and it makes sense though if you think through it, right, is that paying a dividend typically says to investors, hey, I'm not going to grow as fast. Which the reason that that's strange is because, hey, you're returning capital to your shareholders, right? It's like you're doing something that's good, but hey, I'm not going to grow as fast because I am not finding a way to use this money other than giving it back to the shareholders, right? And that's the case that a lot of companies who don't pay dividends, that's the case that they make. They're like, hey, I have the ability to go out and invest this money in a way that will make higher returns than the money that would be returned to shareholders. And ultimately, that's good for shareholders. It's good for shareholders if you can reinvest money at higher rates than the rate at which you would return capital to them. I mean, that just makes intuitive sense. That's a old Warren Buffett thing, right? Warren Buffett always said, it's not all about the cost of capital and making project decisions. The whole idea is if I can return to shareholders more value than the value I can create by keeping the money in the company and reinvesting it, then I'll return it to shareholders. If not, then I will reinvest it into the company. And it's really that simple. So dividends are just one way in which investors get paid. Obviously, there's the whole idea of share repurchases, right, which is seen as by some people a substitute to dividends, by some a complement to dividends, but I would say it is a substitute in many cases, because ultimately this is also companies returning capital to shareholders, but doing so in a more tax efficient way. Because with dividends, you're going to be taxed on the dividends that you are paid, right? If you're paid these dividends, you're going to be taxed on them. But if you have some of your shares repurchased, right, or ultimately if they repurchase shares from, let's say, institutions, and you're a shareholder, well, your share price is going to increase, right? You're going to have a higher share price, but nothing else happened, right? So ultimately, that's not going to impact you in a taxable way in the same way that having dividends paid to you would. Now, with dividends, there's this big idea that people look for, right? Obviously, they're looking for a certain return, right? And with dividends, we call this a dividend yield, okay? So people who are looking for some, semblance of income, but they don't want to invest in bonds, they still want to be invested in the stock market, they typically look for dividend-paying stocks. And ultimately, they're trying to look for dividend-paying stocks that have dividend yields that are reasonable enough for them to justify investing in these companies. So just for instance, right, I'll just give you a quick example of what may not be super interesting to investors. So let's talk about a company like Apple, right? Apple obviously has been a high growth company for a long time, but it's one of the largest companies in the world. And their dividend yield is 0.58%. Right? So it's not high at all. That is not a high dividend yield at all. That means per year, they're paying you 0.58% of the current stock price in dividends, because that's how you get the dividend yield. You go the dividend on an annualized basis divided by the current stock price. So the dividend yield is all based on whatever the current stock price is, because that's the price by which you'll return whatever return you make on the stock is going to be based on, right? Because if I bought the stock today, I bought it, the close from last week is 151.07, right? I buy it at 151.07. That means I can make 0.58% on 151.07 over the next 12 months if the dividend stayed what it is today. So that's a very low dividend. That's not something that would be super enticing to investors, or a reason that would be very high on the list as to why you would invest in a company like Apple, right? But there are other companies, a lot of companies like, let's say Chevron, right? Chevron is a company that's, it's been around for a long time, oil company. You see Chevron gas stations. And if you were to buy Chevron stock at 114.74, you could have a dividend yield of 4.67% associated with that particular stock, which is a pretty good dividend yield, right? So stocks vary in the amount that they pay relative to their stock price, right? But ultimately, the stock price can fluctuate up and down, right? And as the stock price, blows up, then yields tend to shrink because dividends aren't changing at the same rate that the stock price is. But as stock prices drop, if dividends are still remaining as those stock prices drop, then what you will see is higher dividend yields than we previously did. So this kind of brings me to this article that I ran across that says tough times for income investors, even with payouts at a record, dividend yields are measly. Okay, and that brings us back to this whole idea that the stock market is hitting new highs, right? So even with dividend payouts being at highs, if the stock market keeps going up, then yields are going to be hard to come by. So after a disastrous 2020 when many corporations were forced to cut dividends, these payments to shareholders have been rising for the last several quarters. The dollar value of dividends paid on the S&P 500 will likely hit a historic record in the third quarter and for the full year as well. Dividends are back. Howard Silverblatt, senior index analyst at S&P Dow Jones Indices, told Bob Pisani. S&P 500 yearly dividend payouts in 2017, they were $420 billion. 2018, $456 billion. 2019, $485 billion. 2020, it went down a little bit to $483 billion, but there's no surprise as to why that was. That was because a lot of companies were cutting their dividends in the midst of the pandemic. And then 2021 to date, $522 billion have been paid in dividends. That's up 8.1%. So nearly 300 companies in the S&P 500 have raised their dividend this year. Overall dividends in the second quarter were up 4% from a year ago and 6.5% higher than the pandemic lows set in the third quarter of 2020, according to BMO Capital Markets. Elevated cash levels, below average payout ratios, and an unprecedented recovery in corporate earnings are setting the stage for an extended rebound in shareholder distribution, in our view, which should ultimately be a positive for the U.S. stock market in performance as we look ahead to 2022, Brian Belsky, BMO's chief investment strategist, said in a note to clients, right? So he said elevated cash levels, below average payouts, and an unprecedented recovery in corporate earnings, right? So all those things can lead to more dividends being paid out, right? So dividends could be, increasing at a higher rate as we look forward. But something that we may take into account is that so many companies are finding that, hey, if I repurchase shares, investors aren't expecting share repurchases at such a, quarter by quarter basis like they do with dividends, right? And they're not expecting a certain amount of repurchase in the same way that they expect a certain amount of dividend being paid. So I would even posit that maybe some of these companies, after having to cut their dividend last year, are saying, hey, I can return capital to shareholders and I can do so in a tax efficient way. Maybe I'll just repurchase shares instead of going through this whole process of reinitiating a dividend or, increasing a dividend again or whatever, right? This whole process that investors are going to become, very tied to this dividend and very, emotionally stuck on this particular dividend. And maybe they don't want that to happen, but that's just my thought process. Now, in particular, we have energy companies that have either been assuring investors that the dividend is safe, like ExxonMobil, or hiking the dividend after many slashed these payments in the past several years. So in the past month, Viper Energy, Devon Energy, Chesapeake Energy, DTE Energy, Marathon Oil, Oasis Petroleum, and Diamondback Energy have all hiked their dividends. Other companies that have recently raised their dividend include Estee Lauder, Simon Property Group, U.S. Steel, and Voya Financial. So not insignificant companies here have been increasing their dividends. Now, here's why dividend payouts are at a record. The reason that corporate America is making record dividend payments is simple. Cash flows have been getting stronger as the recovery has proceeded. So as the economy is recovering, we're seeing stronger and stronger cash flows by these companies. So corporations are able to divert more money to buybacks, share repurchases, and dividends. Dividends and buybacks both come out of cash flow. And now here's how corporate America spent its cash flow in the second quarter of this year. In the second quarter, 21% of cash flow went to dividends, 33.8% of cash flow went to buybacks. So maybe some of what I'm suggesting may actually be the case, right? It may be the case that they are buying back shares, in a more egregious way. I don't know if egregious would be the right word, but in a more aggressive way, maybe, right? Capital expenditures, 27.8% of cash flow went to capital expenditures. 18% of cash flow went to retained earnings or paying down debt. Okay, so a lot of capital going to dividends and share repurchases, right? Now, while the dollar value of dividends has risen this year, dividends as a percentage of cash flow has decreased slightly in recent years. Dividends have indeed gone up because cash flows have increased. However, you are not getting a bigger piece of the pie because money is being spent in other areas. Over the last several years, corporations have been spending more on buybacks than dividends, and also less on capital expenditures. Well, there it is, right? Companies are spending more on buybacks than dividends. Now, why the emphasis on buybacks over dividends? Buybacks are easier to control. You can stop or increase a buyback, right? Dividends and capital expenditures are long-term and difficult to reverse. It's difficult to reverse, like I said, a dividend because of investor preferences and of investor expectations. But when it comes to capital expenditures, it's also difficult to reverse those as well because you're making an investment in a project, or you're making an investment in something or some software or some hardware or something, right? You're making an investment in something, and it's hard to go back and reverse that and get your money back from that particular expenditure. Now, here's the bad news. The bad news is because of the relentless rise in the S&P 500 this year, up about 24% year to date, dividend yields at 1.3% are near historic lows, right? So like I said earlier, right, as stock prices rise, then you're going to see yields fall because dividends aren't rising at as high a rate as the stock prices are. Now, the last time yields were this low was September of 2000 when they hit 1.14%. The long-term average since 1936 is 3.54%. Okay, but again, I'll give you a word of caution about that long-term average. That long-term average also has a lot of data in there when share buybacks weren't what they are today, right? So if we're talking about total payout or total, capital redistributed to shareholders or returned to shareholders, then we may be actually closer to this 3.54% number than this article may make it seem. But ultimately, it's not wrong. Dividend yields on average have been 3.54%, but we're currently at only 1.3. Now, that's a bit strange. Corporate America is paying out more money than ever in dividends, but dividend yields are near a record low, right? That may be why investors are not throwing money into dividend-yielding stocks this year. For example, there have been modest inflows in the past several months into exchange-traded funds that pay higher dividends, such as the Vanguard High Dividend Yield Index, the ProShares S&P 500 Dividend Aristocrats ETF, the Wisdom Tree Quality Dividend Growth Fund, right? However, this pales in comparison to the huge inflows into plain vanilla index funds like those that are tied to the S&P 500, like the Spider S&P 500 or the iShares Core S&P 500 ETFs, or to the Russell 2000 or the NASDAQ, the iShares Russell 2000 ETF or the Invesco QQQ, which tracks the NASDAQ. Now, investors are choosing more targeted, value-oriented ETFs, or they're choosing more broadly diversified ETFs rather than owning companies that have historically increased dividends. The stocks that have attracted yields are in more defensive sectors like utilities and consumer staples, and investors are favoring growth over those defensive sectors. Second, yields are low, which makes dividend investing unattractive for many. It's kind of this cycle, right? It's this cycle where as the market grows, yields they drop. And then ultimately investors see that yields have dropped, and so they're not interested in buying, dividend yielding stocks, right? So they'll buy more into growth, and so the market may continue to rise and yields will fall. But the question is, when does this reverse, and when does this, not become the case anymore? It seems like it would be an ever perpetuated cycle, but that's not necessarily the case. Now, if earnings continue to rise, you should see dividends rise, right? Because as earnings rise, companies are going to have more cash flow, more money that they can choose to allocate in any particular way. And one of the ways that they may do that is via dividends. However, it's hard to live on dividends because yields are so low. There is hope. Belsky says that those dividend yields will start to rise as cash flow continues to improve in 2022. Even with dividend payments for the S&P 500 already on pace for a record-setting year, we believe that there is further room for growth in the coming periods, he said. So let's just think about this fundamentally for a moment, right? If you have dividend yields that are extremely low, as we do, right? What you need in order to get higher yields is for the growth rate of dividends to be higher than the growth rate of the stock market, right? So if dividend yields are to increase back to some point where they are higher than they are today, then you need one of two things to happen or both to happen, right? You need either dividends to rise, which they're saying, hey, dividends should rise as earnings are strong. Fine, right? So you may have one of those things occurring, right? But the other thing that may need to occur is the stock market value drop, right? Or the value of any particular stocks drop. Because as the value drops, as the price drops, right, and dividends rise, then you will see higher yields. Or just as price drops, you'll see higher yields. Or just as dividends rise and the price stays the same, you will see higher yields. Right, so one way or the other, if we're going to see higher yields, the only way it's going to happen is that if the growth rate of dividends is higher than the growth rate of the stock market. So the question is that going to happen or not? And then, why does it matter if it happens or not? Because you may be listening to this episode going, okay, dividend yields, share repurchases, all these things, right? Why does it matter? Why does it ultimately matter to me if yields rise or not? Well, I don't know if it matters to you specifically, but it may matter to retirees, right? And it may actually matter for the common investor a lot more than they think it might, right? So let's just talk about the S&P 500 for just a moment, right? And let's just talk, we're not going to even look at a long-term average. Let's just talk about the last 10 years, okay? We'll just talk about the last 10 years. The last 10 years have been phenomenal for the stock market, undoubtedly, right? The annualized S&P 500 return over the last 10 years, if you just look at the price, S&P 500 total return, right, is 14.373%. That's the annualized return. So that's per year. But then if you took the dividends of the S&P 500 and reinvested them over that 10-year period, right, it would be 16.532% annually that you could have returned. So that is like another 2.2% on the upside, right, that you could have gained just in the last 10 years. But let's not just look at the last 10. The reason I look at the last 10 because obviously that is what's most relevant to us today. But let's say the last 50 years, right? The last 50 years, which we could back up to 1971. The last 50 years, we've seen an 8.165 annualized S&P 500 return, right? But if you take into account dividends, you reinvest your dividends, you could have had 11.234% a year. So that's picking up an extra 3.1% annually just on dividends. Okay, so dividends do make a big difference in the returns that you ultimately make because, an 8.165% annualized return on the S&P may be just fine, right? That's whatever. That could be perfectly fine. You could grow your money at that rate over a long period of time. But 11.23% sounds a lot better, and the only way you were getting that is if you were making dividends and ultimately reinvesting those dividends back into the S&P 500 companies over time. And then the question comes, okay, maybe it matters for long-term growth. Maybe it can help your long-term growth, but who else can it help? What else is it important for? Well, there are a lot of retirees, right, who are trying to live on income that they're creating for themselves, right? They're trying to live on income from bonds, and they're trying to live on income from dividends, right? And as yields are lower, then they are bringing in a lower percentage of the amount of money that they have in their portfolio. Now, the good news about this is that the reason that they have lower yields is because the stock market is at all-time highs, right? Yes, we're paying more dividends than we ever have in the S&P 500, but the stock market's at all-time highs. So yes, they could sell some of their allocation into the stock market, into the S&P 500 or whatever other index, right? And get some of that money off in the way of returns, right? But if they're trying to just create a dividend portfolio to pay them dividends, that may hurt. That may be a position where they're having issues in getting the dividends that they want to get. Even more so if you are just retiring, right? If you're just now choosing to retire, if you're trying to retire in 2021 and create income for yourself moving forward, right? Then you're in a position where you're looking at all-time low yields as far as the dividends go, right? And it's not all-time lows, but we're getting close, right? And then bond yields that are extremely low. So ultimately, what are your choices, right? Yeah, you can go out there and find yield, and you can go find some sustainable yield, right? I don't want you to think that there's nowhere that you can go find yield, right? But overall, yields are low. Overall, on a diversified basis, it's far more difficult to find yields that are high or just moderate relative to history, right? So it's difficult. It's difficult if you want to buy, diversified portfolios of stocks or diversified portfolios of bonds to find the yields that you want with a moderate amount of risk, right? But what does this force people into doing, right? What this typically forces people into doing is doing what we call reaching for yield, which is not a good thing. Okay, as the stock market rises and yields fall, there's still going to be companies out there who pay very high dividends as a percentage of their price, right? But you, again, have to think about the reason that this may be the case. This may be the case because a company's stock has fallen a lot, right? So you may get into this trap where, they have a high yield, but the question is that yield sustainable? Is that yield going to remain? You may look at a company that has a 6% dividend yield and go, great, 6% dividend yield. Right now, that's fantastic. All right, but why is the yield 6%? Has the yield always been 6%? Are you going to be able to continue yielding 6% moving forward, right? Or are they going to cut that dividend because the stock price has fallen so much and their cash flow is not keeping up, their earnings aren't keeping up, and that's why they have such a high yield, and it's a short-term phenomenon that they have a yield that is that high. right? So you have to look at why a yield is a certain way that it is. And people do this in the bond market too, right? They take on more risk than they need to take when yields are low, because ultimately, let's say an active portfolio manager, or just a portfolio manager of a bond index fund or a bond actively managed mutual fund, they're trying to find a certain amount of yield, right? They're trying to provide their investors with a certain amount of yield. The problem is when yields are low, they're still trying to provide that same amount of yield. Well, ultimately, we know there's a risk-return relationship. So if you're trying to create more return relative to average, then the only way you're going to do that is by taking more risk. So what they may do is invest in bonds of companies that have more default risk, or have more volatility of their cash flows, or volatility of their earnings, right? So again, you take on more risk to get higher returns. And this is not 100% wrong, right? Because we know that that's the relationship that must be taken there, right? You have to take on more risk to get more return in those cases. But ultimately, we don't want to get into a position where we have to reach for yield so much. So how can we circumvent this in our own lives, right? I'll just wrap this up really quick with how we can circumvent this, especially as we head in to later years of our investing, and we get to the point where you want to retire, or ultimately you want to continue living on your money in retirement. The way you can do this, and I know this sounds very simple, but people are going to roll their eyes at it. The way you can make this not such a big deal is by having a portfolio big enough to where you don't have to just worry about one particular amount of yield that you pull off of your portfolio, right? Because if you're just worried about, hey, I just need to pull 4% off, 4%, 4%, 4%, and then the market doesn't provide 4% in a dividend yield, and you can't find 4% in bonds, and you're struggling to find 4%, and you can't pull it off of your investments because you have to make 4% of that amount, or you're not going to be able to cover your expenses. You don't want to dig into your principal, right? If you're in that position, then that's going to be tough, right? It's going to be tough for you with these yields. But if you have such a large portfolio, and again, I'm not saying exorbitantly large, but if you have more than you might need to just barely meet your expenses at that 4%, let's say you still need that same amount, right? But you have twice the size of a portfolio, right? Well, now you need half the yield. Right? Now you may be getting that 4% a year or whatever, right? But you only need half of it, right? You only require half of it, which is fantastic, right? So ultimately, we want to put ourselves in position over the long term where we don't have to rely on dividend yields being whatever they are, because again, we have no control over them. Because as stock prices rise, they may fall, and if their growth rate doesn't keep up with the growth rate of the stock market, then they will continue to fall. Right? So we just need to keep this in mind. Keep in mind that dividends are a big part of investing. They have been historically, but we need to keep in mind that if we are trying to make money via yield, that sometimes yields can fall, right? And sometimes we can benefit from the other side of investing, which is just the growth. I mean, and that's, most of how we benefit from investing anyway, right? But be happy with the fact that you can invest and make the money that you can, the gains that you can via the growth. But ultimately, dividends should be something extra. Dividends should be something that, yes, you can, pretty much guarantee that some type of, capital being returned to shareholders will be around for a long period of time, or really as long as the stock market will. But you don't know how it's going to materialize. Is it going to materialize via dividends or via repurchases? And my guess would be more and more via repurchases over a long period of time. So we may have to rely on our growth. We may have to rely on the gains that we make via growth, and not just the dividend yields that we may be trying to get in order to fund whatever it is that we need to fund, something like retirement. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals, and ultimately pushing pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.